Hi guys, this is Terry with Futures.io. It's my honor to welcome back John Grady from No BS Day Trading for today's webinar, Choosing the Right Market. Today's webinar is sponsored by Jigsaw Trading. If you have any questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. Also, please feel free to share, comment, and subscribe to our channel. It really helps a lot. Don't forget that you can also follow us on Facebook and Twitter at Futures.io. And I'd like to direct your attention to our current webinar schedule. You can view this updated schedule on our homepage at www.futures.io. Without further delay, I'll hand it over to John.
All right, thank you, sir. I'm sorry to say, I don't have the share screen. Ah, there it is. Okay. Let me pull this up. All right, can you see I have it on my homepage right now?
Yep, looks good.
All right, cool. Thanks, Mike. Okay, so thank you very much for having me back, Mike. I appreciate it. I guess the last presentation went pretty well, so I'm hoping that I'll live up to expectations again today. And thanks a lot to Peter, Jigsaw Trading, for sponsoring this. I do use this platform. I prefer it over others just for my style of trading, so if you haven't checked it out, definitely check it out. It's a really good market depth tool. And with that, we will get right into today's presentation. I had been thinking about putting together a presentation on choosing the right product for a while, and the reason is because a lot of people struggle with this in the beginning. So at least a couple times a month, I get emails from people, and they're trying to learn, they're trying to get into it, but they don't know where to start, okay? So let me preempt this with, I trade predominantly off the order flow, so predominantly off of watching the ladders, the order book, the depth and sales, and not so much off main technicals, okay? And I covered that in the last presentation, so I don't want to focus too much on that today. But what I'm going to focus on is if you're watching the order flow, how it makes a difference depending on if you're trading mostly highly liquid products or products that aren't very liquid, all right? So the way that I want to start that is I have some documents that I'm just going to pop up throughout the course of the presentation today. And these are my notes to sort of help me stay on track and not ramble on for too long. And so the first thing that I want to talk about is prop firms. So I actually did work for several prop firms. I worked for an equities firm when I first started. I worked for a couple prop firms that were futures firms in Chicago. And so frequently when I get emails from people and they're struggling, the first question I ask is, what are you trading? And usually what they say is crude oil or gold or the euro, sometimes the E-mini S&P as well. But often where they're starting is with very, very thin, fast products. And so the first thing that I typically suggest, you know, if a person wants to try something different, is to look at a thicker product. Now, with prop firms, and we're talking here about prop firms that actually hire people, like they go through the process, they interview people, and they bring you in and put you on a desk in their firm. Most prop firms do not put new traders on products like oil or gold, and often not even on equity indexes. New traders are usually only allowed to trade very liquid products. The interest rate products are standard for new hires, something like U.S. Treasury notes or bonds, and the bund, bobble, and shats. If you talk to guys that are in Australian prop shops, you'll see that they're often trading Australian bonds. And if you talk to guys in Canada, what you'll see is they're often trading the CGB, which is a 10-year Canadian bond futures contract. And I know a guy up there who traded for a fund, and everybody in the office was on the CGB. Sometimes traders trade them outright. Sometimes they trade spreads. So spreads are also very popular in most firms. It can be a spread between different products, such as a knob, which is the 10-year note against a 30-year bond. And by the way, if you don't understand this at the moment, don't worry about it. It's not a big deal. You'll get it, and it takes a little bit of research to bring yourself up to speed on it. Or the FIGHT, which is the 5-year note against a 10-year note. It can be calendar spreads, like the September contract against the December contract in the same product, or it can be a spread between the futures market and the cash market. If traders trade stock indexes, they're usually only trading the E-mini S&P or maybe the Euro stocks if they're in Europe. They're usually not on the NASDAQ, Dow, or DAX. So when I was in my office, nobody was on equity indexes at all for the first year they were in business. Once they progressed a little bit and started building new desks, they did put some people on equity indexes, but in the beginning, everybody was on interest rates. So prop firm managers know their traders are far less likely to get hammered if they trade more liquid products. All prop traders usually lose when they first start, as do all traders in general, because it's a learning curve. But they're going to lose less and have less volatile swings if they are trading very liquid products, okay? So if they can prove themselves in liquid products, then they may be given permission to trade thinner products. So that's where it starts. And I wanted to start with that so that you understand this is not just my opinion. It's kind of how it works within the industry, and if you talk to other people who have worked for other firms, they'll tell you the same thing, okay? So why is choosing the right product important? It's important because a lot of people, when they first start, they think they can use a one-size-fits-all mentality, and they usually think that because they're trading based on technical analysis. So they start learning about trend lines and patterns and candlesticks and all this, and you look at that and you think that you can apply the same strategy to every market, and nothing could be farther from the truth. And I'm going to go through some sample trades and some live footage that I recorded just to kind of demonstrate the differences. But let me just cover this very briefly. So when people first start trading, they're often drawn to the most volatile markets because it seems like those are the markets which offer the best opportunities for making huge sums of money very quickly, particularly if you're only trading one or two contracts. So keep that in mind also in the beginning. A lot of people start trading volatile products because they have small account sizes, so which really you should definitely not do at all, but that's what they do because they're trying to put maybe $2,000 in an account and they see a big move in a thin market and they think, man, I could have doubled my account size, in one day if I'd been trading this market. But what they don't realize is if you become, good at other markets which are more liquid, you can make more money trading bigger size for smaller moves. So they often start with crude, gold, the DAX, some thin markets which have large intraday moves. They're appealing because, like I said, it's possible, although not probable, as I wrote, to make 2,000 or 3,000 or more per contract on a very busy day. More liquid markets, which are not as volatile, may only move 200 or 300 per contract in a day. So a crude oil or gold trader may make or lose 1,000 per contract in 5 minutes on a big run, and it's very rare to see that kind of move in the E-mini S&P, the notes, the Euro stocks, the bond, or other highly liquid markets. The next paragraph here is just about boredom. A problem for many traders is boredom. So if a guy's been watching crude for 6 months, he might start watching the treasuries based on my suggestion, and if he's watching during a slow week, he feels like he's watching paint dry. Now, if you watched last Friday during non-farm and you watch today, you'll know that this is not true, but that can happen. So sometimes I direct people to like treasuries, and they watch during a slow period or during rollover, and they think that it's boring, and they go back to the crude oil market. However, trading for a living isn't about excitement, it's about money. And if you obtain better results from trading a slower, more liquid market, then that's the market you need to be trading, right? A question which most people never ask and generally can't answer is, do I have a true viable edge? So by viable edge, what I mean is, are you consistently making calls that have a better than 50-50 chance of working? Is there actually a solid reasoning behind the entry and exit? Is your performance better than random results? And is there something which is helping you predict the future? And again, just bear with me while I get through this. We're going to progress the trades in a minute, but this is very important to understand the topic today. Try to remember when you're trading that you are attempting to predict a future over which you have no control. Okay, what do I mean by that? What I mean by that is you can't move the market. At least most people who will be watching today can't move the market. So by move the market, I mean you're not trading hundreds or thousands of contracts, which might actually be the support area, or might actually be the amount of size which is required to trigger off a stop run, let's say, okay? Most people start trading 1s, 2s, 5s, maybe 10 contracts, and you're up against guys who are trading thousands of contracts. So that was something I discussed in the last presentation. So you have to realize that what you're ultimately trying to do is you're trying to get in front of larger orders that are going to cause movement in your direction, okay? And so the reason most people don't have a viable edge is because they forget about that premise right from the start. In a liquid market, there are times when hundreds or thousands of contracts trade at one or two prices, and that information can help a trader determine future movement. In thin markets, there are areas of high and low volume, but you are often at the mercy of the next 50 or 100 contracts which trade, and those trades can start a chain reaction which takes the market 20 ticks in one direction or causes very nasty whipsaw type action, right? So if you trade crude or gold or the DAX, let's say something like that, if you watched it for even a week or a couple of days, you'll see areas where it may only take 10, 20 contracts to set off this chain reaction, which is predominantly HFT, driven movement. And so if you're trading a liquid market like the ES or an interest rate market, or maybe the Euro stocks, you can actually see a few hundred to a few thousand trading at certain spots, and that can sometimes clue you into movement, all right? So in my experience, trying to pinpoint the best entry and exit prices is much more difficult in thin markets. Most retail traders try to pick profit targets and stop-loss prices using some basic form of technical analysis, which is often not any better than a random guess. So to kind of illustrate this point, and I'm not picking on people who say this, I'm just trying to make a point and kind of make you think outside the box. I recently had an exchange with a guy who told me, he was like, hey, I made some money by identifying a swing low today. So I asked him a few questions, and the first question, of course, is do you consistently make money by identifying swing lows? The answer to that is usually no. And one of the problems is when it doesn't work, they don't know why, right? So that's problem number one. The next question is who coined the term swing low, and what does that mean exactly? So when people fire off terms like swing low or overbought or oversold, it's a very subjective term, and everybody has their own idea for where the pivot point may be and why they feel it's that way. And people often ask me, well, isn't reading order flow subjective as well? And it's far, far less subjective, and I'm going to, again, go through that as we progress today. What data does this person use to determine if it would be a swing low? Again, we're back to what are you looking at that's making you decide this is a swing low area? And then, most importantly, or what I think is most important, is this person or is somebody going to be working a buy order for 5,000 contracts at that swing low price, all right? The answer to that question is always no, because anybody who's working a buy order for 5,000 contracts is not going to broadcast that news ahead of time. Why do I say that? I say that because a price or group of prices being called a swing low, according to someone's data projections, is not what stops a down move. Buy-side demand overwhelming sell-side supply is what stops a down move. Size stops a down move or an up move, as the case may be. So the market might be moving down, and you may have a projection that this area, quote, should be a swing low. But unless a lot of buy-side orders come in that area, your swing low is not going to hold, right? So rather than responding to your projection of a swing low, it's better to respond to actually seeing size come into the market and start bidding and holding at those prices first before you just randomly put a buy-side order out there, okay? So bringing this back to the topic of choosing the right market to trade, in my experience, it's easier to make consistent reads in liquid markets because you can see that size trading, and it makes a big difference when it comes to trade management, okay? Thank you for sitting through that. It will come into play as we progress. A couple bullet points we're going to go through today. Identifying logical profit targets and stop-loss points, risk-to-reward ratios, speed, slippage, size limitations, and diminishing returns, and then what I call the tick-to-commission ratio. So let's start with these two because they go hand in hand. Identifying logical profit targets and stop-loss points and risk-to-reward ratios. So when I say thick markets versus thin markets, this is a group of what I would call fairly thick markets. You have the 10-year, the 5-year Treasury notes, the E-mini S&P, the Euro stocks, and the bund, all right, moving from left to right. And what you'll see on each one of these ladders is that there's a lot of size. I mean, with the 10-year notes, you see thousands, right? 3,000, 3,000, 1,300, 3,000. With the 5-year, you see 800, 400, 1,700, 1,700. Not all that trades, but usually you have at 5, 6, 700 at every price. The E-mini S&P, as we know, could be anywhere from 250 to 1,000 or 2,000 at each price, and so on with the Euro stocks and the bund. The bund is a little bit more thin, so I don't usually suggest people go with that at first, but it does have some size. Now compare that to thinner markets such as crude oil, gold, the Euro, the Dow, or the DAX, all right? And if you look at these ladders, what do you see? 16 by 7, right? 11 by 26, 3 by 22, and just it's very, very thin size on each one of these products. So let's discuss why that's important with the idea of trade management. Excuse me one second. Had to get a drink of water. So when I'm pulling out recorded trades to try to do a presentation like this, I don't just try to pick trades where like, hey, I made a winning trade and I'm a genius. All right? So I don't want anybody to think that I make winning and losing and break-even trades like everybody else. What I try to do is I try to find a trade or some sample trades that illustrate the topic at hand. And so what I've done is I have a 10-year trade that I made, and I have a crude oil trade that I made, and the entry is very similar, but I'm going to go through them so you can see the difference in trade management. Now, in this particular sample, treasuries were moving up, and it looked like they were hitting a point where they may stall out and retrace a bit, okay? Why is that? There's a combination of factors, and that's not really the topic at hand today, but it's a few factors involved, ranging from volume trading to the context, and also just sort of knowing how your market behaves. And so what happened is I ended up taking a trade here at 29, and I'm not going to go through the entire thing, but you can see that right there I ended up getting short at 29. And in this scenario, based on understanding a more liquid market like this, I know that I'm pretty much at, if I'm right, I'm at the right price. So in other words, the market really shouldn't go through me here. And so it shouldn't even go to 30 or 30.5. So from a risk to reward standpoint, right, I'm only risking 2 to 3 tops on this trade. And I know that if I'm right, I'm going to at least get 2 to 3. So I'm definitely going to get 1 to 1 in this scenario. But if I'm right in a bigger way, I might get 4, 5, 6, maybe even 8 ticks. It depends a lot on what's going on, and I try to feel it out as it's happening. But I know that I'm at least getting a 1 to 1, and it won't take much to get that 1 to 1. And I might get 1.5 to 1, 2 to 1, or 3 to 1 on this trade. So it's common in this situation when you're dealing with liquid products and you can see some volume trading that you can identify areas like this. Now, I'm not saying it's easy. I'm not saying you're going to do this overnight. I'm just saying that it's easier to find this in a liquid market than a less liquid market. And so in this particular situation, I'm just going to scan through a little bit, so it's going to move fast. The market bounces back and forth for a little while, and then eventually it does end up dropping in after it goes to my price again a couple times. And I am scanning forward, so so you understand it's not real time here. It takes a while for this to play out. And then right here, I end up deciding that based on what I know, I probably need to scalp the 4 ticks at 27. Okay, and it took about 3.5 minutes for this to play out, and I end up covering the trade for a 4 tick profit right there. Now, it doesn't look like a lot, and I realize that traders who trade fast markets, they're like 4 ticks, what is that? That's nothing. But you have to understand this is how more liquid markets behave. And so a very important point to understand is that, you know, 2 4-point winners is the same as 1 8-tick winner, right? Or 3 4-tick winners is the same as 1 12-tick winner. And it's often a lot easier to identify a 3 or 4-tick winning type trade, particularly in a range-bound liquid market, than it is to sit there and wait for 2 hours and hope that you make a 12-tick winning trade. And that, of course, goes back to the idea of responding to what you're seeing in the moment rather than having a preconceived notion that, hey, I know where the market's going to be in an hour from now. Not to mention, if you think you know where the market's going to be in an hour from now, you may very well miss a lot of smaller opportunities in that hour. There may be 3 opportunities to scalp 3 or 4 or 5 ticks over the course of that hour, and if you sit in a trade for an hour, you may not even make 10 ticks on your one trade because you sit through a bunch of chop. All right? So let's compare this. You know, it's a slower type situation with a lot more volume that trades, but it pans out and I'm risking 2 to 3 and I end up making 4 on a trade like that, right? So this next situation is an oil trade. Now, I will point out to you that this was a sim trade because I don't trade oil and I didn't want to just, you know, blow through a couple $100 trying to find a trade for a presentation. But the idea is still the same, and the execution is the same. And in fact, it was by watching price action that I decided, hey, you know, this might be a decent short scenario in crude oil. But here's the difference. You'll see that I'm short from 41, okay? With crude, I cannot set a 2-tick stop loss. It just can't happen. As you see, the market's already printed 2 ticks above me, so I would have been stopped out anyway had I used a 2-tick stop loss. And really, I can't even use a 3 or 4-tick stop loss. You know, if you've watched crude or a thin product for much time, you know that the market can move through you very easily by 2 or 3 and then come right back to your price and then maybe in the direction of your price. And this is one of the things that I'm trying to cover here is how do you establish a very logical stop loss point in crude oil? So some people might say, well, the market's moving up, why are you shorting anyway? Well, I'm shorting because the price action is telling me that the market may stall out here and go back down, the same way it did in the Treasury trade. Okay, so the read itself is not, you know, it's a valid read. It is a valid read, but the problem arises with where is my logical stop versus a logical profit target? And in this situation, as you'll see when I scan forward a little farther, there was no clearly identified resistance level of any kind above this. There was no resistance, technical resistance, on a chart, on a daily, on a minute, anywhere. And so you're sort of in the situation where you want to take advantage of a potential move and a retracement where the market might stall out and pull in, but you'd have no real clear concept of where your stop needs to be, right? Because I don't want to blow out at 44 or 45 and have the market come back into 31, right? So for this particular sample, what I did was I said, okay, let's go for a 1-to-1. We'll set our stop at 53, which is a 12-tick stop loss, and we'll go to 29, which is a 12-tick profit target, and this will be the 1-to-1 in a crude oil trade, okay? And so it took a while for this to play out, and ironically, it played out better than I could have imagined, but the market trades here a bit, and as it trades, you know, it pulls in a little bit and then hovers in this area. And even this hovering kind of makes me think I'm on the right side. I'm pretty sure I have the right read here, but let's just feel this out and see what happens. And then it jumps right there a little bit. Now this is what I'm talking about. I'm going to back this up. Right there. So now if I have a stop at 46 or below, I'm stopped out of this trade, right? So once again, this is where I'm trying to identify 3-tick, 4-tick, 5-tick, 7-tick, 8-tick stop. I mean, realistically, where does a stop need to be in this situation? And it jumps a little bit, pulls back in, and I'm going to fast forward down. And there's probably a little bit of a lag coming through, but I'll pause when it gets there. And it takes a while, and finally it does pull in. Now, here's the interesting part. It pulls in all the way to 46.30. It actually prints at 29, which is where my order would be, but it only prints a few contracts, and my order was not filled, as it would not be in real life, you know, because it was at the end of the queue. And so what happens here is you see they print 13 contracts at 29, and then the market jumps off of there a little bit. Now, realistically, if you're trading oil or gold or any of these products, you need to be using probably an automated trade management type system that's going to pull a trailing stop down behind the market once it moves in your direction. I mean, that's realistically how you need to trade these markets. Point and click on crude and gold and the DAX and the Dow it's pretty much game over for point and click. If you want to compete with the HFT programs in the world and thinner markets, you need to be using some kind of an automated, at least once you're in. You may point and click to get in, you know, with a market order, but once you're in, you need to kind of have an idea of where your stop should be set, and you should have a trailing stop following your order as the market moves in your direction. The reason I let this play out is because this was for demonstration purposes, right? And in reality, as soon as the market bounces there, it's only one tick away from my exit price. I'm not realistically going to risk giving back 10 ticks to try to get that extra one tick, right? Nor should you ever do that, and that's a problem a lot of people have. The trade might be 8 or 10 ticks in the money, and they want those last 2 or 3 ticks, and they end up risking the 8 ticks of profit or 10 ticks of profit to make another 2. And they never view it that way. They always view it as I risk 12 to make 12. But in reality, at this point, I'm now risking 10 to make 2 if I let it come all the way back to my price, right? A really fundamental concept that a lot of people don't get when they first start trading. So what happens is it trades around this area, and I just let it go, you know, for, like I said, to see if it would get the fill or not. It goes right back down again to 31, never gets to 29 again, or excuse me, 29, yeah, where that order was. And I start moving the order up, and of course it doesn't get filled, and then it comes all the way back to the entry price of 41. And I just scratched the sim trade because it made my point very loud and clear. That's kind of the difference between liquid and illiquid products. And so a person might say, well, if I had risked 8, I would have made 8, and, you know, been in a situation where I got 1-to-1, which is true. And if you are really skilled at trading thin markets, then maybe you can get a feel for where your stop should be and where your trailing stop should be and whatnot. But usually new traders have no concept of how to do that, and that's why if you learn on more liquid products, you tend to do better once you try to switch to thin products, if you choose to do so. And then what you'll see a little while later is that the market actually did go all the way up to just below where I had that stop loss, right? So it goes all the way up to 50, stalls out, pulls back in, and then comes back to 41 again. And so you just get these really wide ranges, and it can make it very difficult to make any kind of a clear read. What I wanted to show on the chart here was that there wasn't really any resistance point, and that's what I was trying to show, is that the only resistance showing on a chart would have been 45.90, 45.95 in this area from the previous day. You can see it, oil went up, and then stalled out, came in, and that was it. And so going into the next day, when it's chopping in this area, once it finally gets through, which is exactly where that was, which is what I'm showing you, there's not really a spot up here that's a logical resistance point. So if you're trying to make a legitimate read off the order flow, you might be reading the volume right overall, but again, trying to find that stop loss point that's the right stop loss point can be very, very difficult. Now, let's move on to the next bullet point. Speed, all right, or what I call HFT domination. These markets react so fast these days that, again, if you don't have that automated strategy in place, you just can't react at the same speed which these orders can react. And so as an example of that, we're looking at gold here, and it's trading at the low of the day. It's at 13.1910, right? It's going to snap, and it's going to be 10 ticks lower in a matter of 1 second. So if you see it's trading at 13.1910, and then there it goes, right? 13.1820. And so it breaks this level and snaps down really quickly. If you're not using a stop order, you're never going to get filled. And if you are using a stop order, you might actually not get filled until 60 or 50 or 40 because of the volume that's trading. So it breaks from 1910 to 1820 in a matter of a second, and then traces right back up to 1910 in another 2 or 3 seconds, right? If I am in a treasury trade, so this is down and up, right? Let me back up for you. If I'm sitting in a 3 or 4 tick trade, winning trade in the treasury markets, that's never coming back on my price without me taking a profit. I don't have to worry that a few orders are going to drive the market 4, 5, 6 ticks straight back through my entry price, and I'm going to be caught in a trade that went from a 4 or 5 tick winner to a 2 tick loser. I mean, you can also bring, your trailing stop down or a break-even stop down, but you don't want to be in a 4, 5, 6, 8, 7 tick winner and have it be a break-even trade. It defeats the purpose of short-term day trading. So with a liquid product like this, that's not really an issue, whereas if you go to what I just showed you, sorry, trying to find it again, you have that situation where it snaps and comes back on your price so fast that you don't even know how to react to it. And this is what kills a lot of traders, is they try to play a break like that. They play the break after it happens, so they're selling at 1850 or 1860 or 1830, down here, and immediately the market is back 10 ticks in their face. And then once it's 10 ticks in their face, they don't know if it's going to stall and then come back in again, or whether they should bang out and take the loss, or now they have to wait for it to go to 1320. It turns into this really confusing situation, and they have no idea what to do, and they end up, either acting too late and getting in after the market's already broke 10, 12 ticks, and then getting caught as it snaps back, or they act at the right time, and maybe they get a trade-off at 1910, 1890, but when it snaps back, they won't take the break even, and then it turns into a 5, 6, 8 tick loser, and they basically get the deer in the headlights syndrome, right? And they allow a win to turn into a loss, which is what often kills people as well. So just to show, a chart of gold, this is what enamors people, and this is why they get into those kind of markets. You can very easily, I could show a chart like this and say, hey, look at this is gold, this is what you need to be trading. Look at the potential here. And they see a day like this, which was a different day than the one you were looking at, by the way. And they think, oh, all I had to do was buy here, and then the market skyrockets, and you make 1,000 per contract, and then later on in the day you sell it, and it drops, and you make 1,000 going the other way. And it's very misleading. Those days are few and far between, and in the interim, people usually get caught in that kind of scenario which I just showed you, which is they just get whipsawed out of 5 ticks here, 8 ticks there, 10 ticks here, and the next thing they know, they're down 40, 50 ticks in the 10 market, and they're scrambling to try to find 2 25-tick winners to make all that money back, and they can't find one for the next 2 weeks, and they just continue to dig a pretty big hole. And so people look at this and they think, wow, what potential, and then I show them a treasury chart like this, or they see a treasury chart, and they just see a bunch of back and forth and slowness and not a lot happening, and they don't know how anybody can make money in this because it's so slow. But in reality, take for example an area like this where you have about an hour time frame here, actually more than that, 2-hour time frame, But in that 2-hour time frame, it can sometimes be possible to just sell and buy and buy and sell and sell and buy and buy and sell 3 or 4 or 5 times, and you can end up scalping maybe 9, 10, 11 ticks in a 4-tick range. And so the potential is there during slow days, not every slow day. I mean, they can be a little too slow sometimes. But treasuries also move, and to illustrate that point, I scrolled back. The day before that, there was quite a lot of movement, and it was pretty busy. And the day before that, it was also pretty busy with a big down move right off the open. And the day before that, it was busy as well, which you don't always see in treasuries, but massive skyrocketing type movement that happened the day before. If you saw today, the market had a big up run after 10 a.m. And then, of course, on non-farm last Friday, it was the same thing last Friday. Sorry, I was pausing. I was looking at something. So don't let the fact that a market may look slow prevent you from trading it. You may just be watching it during a slow week or a couple of slow days, and ultimately you might find that it's a better read. So again, to go back to our bullet points here, slippage in thin markets and its effect on P&L. Let me just show you this real fast. You may already understand this, but I'd like to share it. Let's take, for example, the Euro stocks versus the DAX. They tend to move very similarly at times. The DAX often moves, or not often, always moves faster on lighter volume. But let's take the idea of slippage just real fast. Let's say you have a stop order set at 56.50 in the DAX, okay? And you see that there's 8, 8, 9, and 12, okay? If you're doing a test or you're testing on a sim, and this is sometimes a problem when you're testing and not trading real money with at least a 1 lot, you think that you might be able to get the fill at these prices. But what happens is when it actually trades there, you don't get filled for 4 or 5 ticks past that price. Whereas in the Euro stocks, which is fairly liquid, I was actually already long, but that's beside the point. 785 was on the offer. If I have a stop order working at 32 for 10 or 20 contracts or 5 or 1, whatever the case may be, almost assuredly I will get the fill at 32. It's pretty likely that I'm going to get the fill there. Worst case, I might get 33, but because there's volume there, I'm probably going to get the fill at my price or only 1 tick past that. And so if we click ahead, what you'll see is the market actually jumps. And when it does trade, only 2 trades here, 2 trades here, 6 here, 7 here, 7 here, and 3 here, right? And so you have a grand total of, 27 contracts. That drives the market 6 ticks straight up. So in theory, you think you were filled at 56.50, but in reality, when that 2 lot traded, it triggered this 2, which triggered that 6, and all those orders beat your order to the market. And so you weren't filled until 58 or 58.50. So you end up getting 3 or 4 or 5 ticks of slippage on that order, and it skews, what you might think is the real risk to reward in a scenario like that. Whereas most likely in the stocks, you get the fill because 656 traded there. And now you might be long at 32 or long at 31. And the flip side of this is that let's say you have that stop set off similar to the gold trade, and you get the fill at 58.50. Well, now if the market suddenly snaps back 6 ticks on another 20 contracts, you're going to be sitting in a losing trade. Whereas you probably still have the chance to maybe scratch at 32, or worst case take a 1 tick loss, or in my case, I was already long at 31, and I can almost assuredly scratch the trade if I need to, depending on the situation. And I realize scratching trades is a novel concept to a lot of people, but it's valid in certain areas, all right? And then, moving along, size limitations in thin markets and diminishing returns. Here's the deal. Even if you become proficient in thin markets, you're going to be limited to the amount of size you can trade with that strategy. So you may develop a strategy that works really well with 1 to 3 contracts, or maybe 4, let's say. But now let's say you're making some decent money with 1 to 3 contracts and you need to up your size and you're trying to increase your profits. If you start trying to trade a 30 or a 40 lot in crude or gold or the euro the same way you're trading a 3 to 5 lot, it's probably not going to work. So you're going to notice that your returns begin diminishing very, very quickly. You're definitely limited on how you can move size in these markets, whereas if you become proficient at trading the 10-year or the 5 or the E-mini or whatever, you can literally trade hundreds, if not thousands of contracts if you were to ever reach that point. You know, that's obviously way in the distance, but if you do become proficient, you can trade that size in the same way. I mean, you can pretty much trade a 100 lot to 200 in the 10-year the same way you trade a 1 lot. Not always. There can be a little bit of slippage, but only of a tick usually. So it's very similar in terms of that. I mean, obviously, if you're trading 3,000, that's a little bit different story, but nobody here is probably at that level, I'm assuming, including myself. So again, if you're trying to learn a market and you want to make real money in the future down the road, is it better to focus on a market where you may be limited to trading 5 or 6 or 8 contracts the way that you know how to trade, or do you want to focus on a market where you're going to be able to up your size to 50, 60, 100 contracts potentially down the road? And then the last thing I want to talk about is tick to commission ratio. So the tick to commission ratio is something that for some reason you never see. I don't know why, because it's a common understanding in the industry, but you just don't see it much in retail material. What it is it's the price of trading a contract versus a tick size. Okay, and as a quick comparison here, I did 3 products. Crude oil is $10 a tick, and the Euro stocks is also $10 a tick. So you have 2 products that have the same tick size. All right, but the exchange fee for crude is $1.45 a side, whereas the exchange fee for the Euro stocks is 30 cents a side euro, which is currently about 34 cents a side US dollar. Let's just keep it the same. Say you pay commission of 50 cents a side, clearing an NFA of 5 cents a side, and you pay $4 a round turn for crude, and you pay $1.78 a round turn for the Euro stocks. $10 a tick divided by $4 a turn is 2.5. What that means is you have to make 1 tick for every 2.5 trades in order to cover commissions and exchange fees if you trade crude oil. If you trade the Euro stocks, you have to make 1 tick per 5.6 trades in order to cover commissions and exchange fees. And then if we scroll down and we're looking at, say, the U.S. Treasury bond, the Treasury bond is $31.25 a tick, and it's only 80 cents a side exchange fee, which is about $2.70 a round turn. So now you have $31.25 divided by $2.70 a turn is 11.5. That means you only have to make 1 tick per 11.5 trades in order to cover commissions and exchange fees. I can't tell you how big this is in the long run. Now, if you really become a good trader, you can eventually become a member of an exchange and lease a seat, and you can bring these costs way down. All right, but again, even when you do that, usually the CME products, particularly energies and grains, are going to be higher than interest rate products or the equity index products. And so if you're looking at long term, you know, for every 100 round turns you do in crude oil, you're paying $400. For every 100 turns you do in the Euro stocks, you'd pay $178. So you're basically giving the exchange, the CME, another $222 for every 100 round turns you do. Obviously, if you can trade crude like a champ and you can't trade the Euro stocks at all, you know, then yeah, of course you're going to pay the extra fee and you're going to trade the product at which you are the most proficient. But if you're not very good at crude and you're not good at the Euro stocks or the bonds or whatever, and you're trying to learn one of them, it makes a lot of sense to learn a product that has a cheaper exchange fee, because if you don't, you're just basically giving away money to the exchange, and you might do better in a more liquid product that has a cheaper exchange fee. Okay, and so to summarize, in the beginning, most traders should not focus on trading oil, gold, the NASDAQ, Dow, the DAX, or other very thin markets. I tell people not to trade Forex or CFDs, contract for difference. Some people would disagree with that, but most people I know who try Forex and CFDs lose. They're just different. They're not as transparent, and it's certainly not the best place to begin. Again, you should probably start with the actual exchange traded products, and if you become decent at those, then maybe you can branch out, but most people do not. Typically, you want to focus on equity indexes, the S&P or the Euro stocks, or interest rate products, 10-year, 5-year, 30-year, bund bobble, Australian bonds, and I say maybe something like corn. Corn is a pretty thick market at times, and there can be decent movement that can be read from the order flow, but the exchange fees are pretty high, and you also need to be seriously aware of limit moves. The grains can have limit moves up or down, and you have to know exactly where that price is if you're going to trade those products. Otherwise, you could get trapped in a limit move, and that's a really, really bad feeling. Once traders get away from the thin markets and start trading more liquid products, they usually see improvement within a few weeks. Not a guarantee, obviously, right? We all say this up front. This is not a guarantee of anything, but in my experience, if people break from thin products, they go to thicker products, they usually do a bit better. You know, I talk to guys, for example, that are in the Top Step Combine. I know there are some, you know, forum posts on Futures.io about that, and typically people who are on the Top Step Combine sims, they're trying to swing for the fences in oil and gold, and if they cross over to a more liquid product, they start noticing that instead of drawing down 10% or 20% a day, they only draw down 2 or 3% a day. Then they may make 2 or 3, then lose 3 or 4, and the really volatile swings in their P&L tend to disappear. Doesn't mean you can't lose, it just means you lose at a slower pace and you learn more while you're losing less money. So they begin to see how they can reduce risk in the liquid products. They see the benefit of better risk-reward scenarios. They see size influencing movement, and gradually the change begins to make sense. All right, and so with that, I'll back out of all this and turn it back over to you, sir.